After delivering spectacular returns for investors in 2024, IonQ stock is down 18% so far year to date in 2025. The company is scheduled to report quarterly financial results on February 26th, 2025, and investors are curious if they should buy this quantum computing stock before it announces earnings. I'll answer that question in this video by looking at the company's latest results in terms of revenue and profit and cash flow, looking at the balance sheet, and then finally looking at the valuation to determine if it makes sense for investors to buy ahead of earnings. So let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So like I mentioned at the beginning of the video, IonQ stock is down 18% in 2025. But if I were to zoom out, let's say for 1 year and not just 2025, you can see the stock is up significantly in that time, 215%. Most of this increase you notice here is from October of 2024 all the way up until early January 2025. This rally was on the back of news from Alphabet and its breakthrough in quantum computing, the Willow chip. That caused a great enthusiasm for quantum computing stocks, IonQ included, because of the potential of the industry. And then you had this letdown ever since then, as you had successive CEOs like Jensen Huang of NVIDIA and Mark Zuckerberg of Meta Platforms put a little water on the flame by talking about quantum computing and how we're not going to have useful quantum computers for at least 10, 15, or 20 years. And that really brought down the enthusiasm industry-wide. Still, I did a video discussing IonQ's response to those comments, and the management team talked about how it doesn't really matter what they say because their voice is not as loud as Jensen Huang and Mark Zuckerberg, noting that they have a lot more influence than the CEO at IonQ. IonQ, in terms of trailing 12-month revenue, is one of the largest pure-play quantum computing stocks there are. At $37.5 million, it generates the most revenue out of any of the quantum computing stocks I'm following, which include Rigetti, Quantum Computing, and others. So in terms of revenue and growth in revenue, it's the most mature, but still, it's a tiny fraction of what this industry could be 10 years from now, 20 years from now. This could be a multi-billion-dollar industry if all the forecasts surrounding what the capabilities are in this technology comes to fruition. So understandably, at these lower levels of revenue, the company is losing a lot of money on the bottom line, has to pay a lot of smart people that command very high salaries, and so its operating margins are going to be negative for a long time. But the good news is that it's improving, right? You want to see some progress. You want to see some revenue generation here, helping give the company not only the money that comes in, but also the experience in iterating this technology based on the feedback they're getting from their partners, from their research partners. And IonQ can learn from their counterparties just as much as they're getting a benefit from the revenue. I find that the learning from serving those partners could be just as valuable and push them along the curve in terms of development of the technology. So they're negative $93 million in trailing 12-month cash flow from operations. And I like to compare that against how much cash they actually have on the balance sheet. And they have $30 million in cash on the balance sheet and zero debt. So if we compare the $93 million with the $30 million in cash they have on the balance sheet, they have a few months of runway before they run out of capital. Now, thankfully, their stock price is up significantly in the last year, and they can sell more shares of stock to raise capital. But also, as the company hits milestones, that will unlock more money from investors. Investors are more willing to give a company money when a company demonstrates progress against milestones. And so there could be more money coming for IonQ as they hit milestones, as they make progress. But they're going to need to go back to investors many, many times again, in my opinion, before they reach a sort of self-sustaining level where the business doesn't need any more money from investors. So looking at the company's valuation, it's still very expensive when you measure it by the forward price to sales ratio of 48. However, I will say it's very difficult to value companies like quantum computing, IonQ in the quantum computing industry, because so much of this company's revenue and cash flow potential is so far away in the future, and it's so uncertain. The range of outcomes is so wide, it's almost negligible in terms of trying to pin them down on a valuation. You would have to try and do several different types of valuations, and I would feel like all of the work that's required in trying to do that kind of valuation would be wasteful because of all the variability, right? What would be the use if I were to tell you that the value of this stock could be $10 per share or $750 per share? That's the kind of wide range would be in my calculations for IonQ if I was to try and pin it down more specifically, looking beyond the forward price to sales ratio, because I would have to be forecasting something a decade into the future for an industry that the estimates are not yet well formulated. The use cases are not yet evident. What is this quantum computing going to be used for? Where is the initial ramp up? Where is the most beneficial technology? How much revenue is that industry going to generate? What are the margins going to be like in that industry? Which companies are going to be successful? Who's going to have how much market share? All of that is highly uncertain. So these types of situations are very high risk, but also very high reward. You could end up making 1,000 times return on your investment with a company like IonQ, but you're also taking a great chance that you lose all of your investment. So this type of investment should only be considered by investors with a very high risk tolerance, or it can also be considered for a portfolio that has a lot of stable, let's say, dividend stocks, and you feel like your portfolio needs some upside potential. You can plug in an IonQ in a portfolio that includes, let's say, 9 dividend stocks, and then including IonQ in there would be a nice upside potential there, just in case the company does strike gold and you get that huge upside. But in terms of answering the question, do I think the stock is a buy right now before earnings? I would say no. I don't see a reason why you need to go in and buy before earnings. Companies like IonQ, when they make breakthroughs, they don't usually wait until the earnings release to announce the breakthrough. So the probability that you're going to get a big announcement in the earnings release or in the earnings call is less likely than most other situations, because they're keen to capitalize on those breakthroughs whenever they happen, like the same day or the next day. These companies want to make the announcement so that they can reap the benefits. The stock price will increase meaningfully, and they might use that opportunity to sell more shares or go to investors and raise more capital. So they're not going to wait maybe a month or two to announce those earnings. So for all those reasons, I would say this is a situation where I would wait until after the earnings come out, digest the information, and then decide if you really want to invest. A good time could be right after the earnings release.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.